Hello, my name is Tyler Hamelwright. I'm a CPA, as you can see. I work at a company called Mesquite Tax. We're a small accounting firm. We mostly handle income taxes and business payroll and bookkeeping and various items of that nature. I also have an insurance license. I'm a notary. So I really help out small businesses from start to finish, as well as help them um, help the individuals of those businesses, whether it's regular income tax filings or they need a deed or a will or a trust. We can help out with those things. Um, a little bit about myself. I grew up in Mesa, Arizona. Been in Mesa most of my life. I went to Arizona State and enjoy living here. I always talk to relatives and friends that live back east and in the snow, and I say that you don't have to ever shovel sunshine. So I'm happy to live here and don't plan on moving anytime soon. Met a few people right after high school that were CPAs, and it just really intrigued my interest. I like dealing with relationships with people, with solving problems and tasks, and then the math part of it comes into it as well. But it's mostly about relationships and people when you're doing people's taxes. Um, the the links I have here on this slide, I outlined them so that we could pull them up and go through them a little bit. These are some of the basic forms that we'll talk about. This presentation is going to go over just some tips about filing taxes and also with setting up your individual payrolls and your withholdings and those natures. So we'll get into the slides as we go. Um, First off, on the withholding, if you pull up the W-4 and the A-4, those forms, they're really interesting, and honestly it's very difficult to fill these out, but I'll give you the simple and basic way that you can. When you first look at the W-4, this one's actually done by people in your family. So if you're a single person and you don't own a home, you just go to a W-2 job and you come home and there's no deductions, then you're probably just going to want to hit single and one. But if you are married, you have kids, you itemize your deductions, then it just becomes a whole variety of what you can do. The basics of this is enter one per person. So if you're married and have two kids, you're looking at four. If you're married and your spouse is working, you may want to adjust that up or down. If your kids are in the child tax credits, you can usually add an extra one as well. So if you are married and you have kids that are ages 6 and 4, then you can look at doing six. That would be four for the people and two for each child tax credits. So the federal does this because there are a variety of credits and benefits that you can get um, from having children that have the child tax credits, the child care credits, etc. So it's really something that if you are really trying to nail this down, then you ought to talk to a tax professional. Um, Otherwise, there's just some basic parameters that are on that form, and you can look at those A through H. On the A4, this is a little bit different. So this is Arizona's withholding, and this is different than they used to do this. They used to take a percentage of your federal withholding, and a couple years ago, they changed this to an exact percentage off of your actual payroll and your gross wages. So, for example, if you earn $10,000 and you select 1.3 on the A4 form, so 1.3%, that would be about $103 for $10,000. So, um, so that's going to come right off of there, and you can adjust that however you see fit. The Arizona taxes are somewhere in the range of 2 to 5%. But you got to remember that Arizona taxes have different deductions than federal. For example, they allow full medical deductions, they allow exclusions of Social Security income and other types of income. So I have a lot of tax clients myself who are elderly and they have Social Security. They have about 20 to 30,000 in retirement, and then they have a lot of medical expenses. And they end up at the end of the year not even paying Arizona taxes because they take away all the Social Security income and then they get to take all their medical deductions. Whereas federal, it's a little different. So this one's another one that if you want to get this thing exact, you ought to talk to a tax professional. One thing I will say is on these forms, if you are someone in the category of I'm living with my parents, they're claiming me, I'm 16 years old and I've got a job at Burger King, you probably ought to elect to not withhold at all because you're potentially going to file and then you won't even have any tax withholding or you won't have any income taxes to pay. So you can elect to not withhold. And that way the government doesn't hold your money. You have to file a tax return. I've had a few clients where their 17-year-old boy just worked at Burger King, didn't know how to fill these forms out. Got to the end of the year and I said, well, you can choose to file your taxes and get this money back, or you can choose to not file. It's not required and just leave the money there. So they basically had to pay me to file taxes to get that withholding back. So it's kind of a tax planning strategy. If you want to not withhold, you can elect to do so and then keep that money and pay it with your tax return. On the tax forms, when you're filing your income taxes, they're the basic federal form is the Form 1040. Now they have a variation of that with the easy forms and some other forms that make it a little simpler. I typically don't use those forms very much just because I don't find that clients want to use them because there's a lot of times where they can have the option of itemizing, etc. So the 1040 form, if you pull that up, you can see the various types of income. You got your normal payroll wages, and you have interest and dividends. You have your small business income. You have your capital sales with stocks, bonds. You have retirement distributions. You have some rentals and farm income, and all these things flow from different schedules. So you can research this further if you'd like. One of the things, if you're diving into a big amount of stock sales, this is where you really ought to have a tax account and take a look at it, just because there's so many variations with foreign taxes paid and the credits there and various things like that. So, but if you're just a simple person who goes to work, gets a wage, and then earns about $30 to $40 in the bank interest savings accounts, then you can probably look at doing this on your own. Other things as you go down into the these are what we call above the line credits, and that's above adjusted gross income credits and deductions. The educator expenses is a pretty simple one. If you're a teacher and you pay for your own materials, you can take approximately $250. Sometimes that amount changes as an above the line credit, just to give you some money off. You can take more deductions, but this comes into the Schedule A. We'll talk about that a little bit later. Moving expenses. This is with working. So if you're working and you move, usually it's over 50 miles away, then you can look at deducting your moving expenses for moving for work. If you have your own business, you can have self-employed health insurance, and you can have other retirement options that you can deduct off the top. We'll talk about all the deductions and credits when you're going to school, but there's a student loan interest deduction and your tuition and fees deduction. And then we'll talk about the benefits of going to each one of those. So coming over on the next page, you got your itemized versus your standard deduction, and that's where we're going to talk about the Schedule A quite a bit. Um, the biggest thing with clients, if they're asking, well, can I itemize my deductions? Um, the main question I usually ask is, did you pay some mortgage interest? If you own a home and you pay mortgage interest, then you have your mortgage interest, you have your real estate taxes, you have your other fees that play into there as deductions. But if you don't, then typically it's very difficult to itemize your deductions just because you don't have enough added up materials. But it's always good to go through the deductions and see if you can. For example, I gave you quickly in the past, in the past of this recording, that you can sometimes itemize your deductions to get all the medical expenses for the state of Arizona. So there's limitations in federal, but in Arizona you get it. You get it all. So if you have some high income, but then you have $10,000 in medical bills, if you itemize your state deductions, you're going to get all those medical expenses, and that will get you itemizing. So main thing to think about is, again, if you're thinking about doing the standard versus the itemized deductions, do you own a house? If you own a house, you are most likely going to be able to itemize your deductions, and this is just going to help you to get some more tax savings. When you're looking at maximizing your deductions, there's a few different tips. And this is just a really general tip, and I think it's a great idea, but if you get married and have kids, you are going to have a whole lot more deductions available to you. There's something called the Earned Income Credit, the EIC. So let me give you an example. If you are single and you are looking to get the Earned Income Credit, the most you're going to get is around $500. But if you are married and you have 3 or more kids, you can potentially get $5,000 to $6,000. So there is quite a bit more that you can get. So if you have the option of getting married and having more kids, I know they cost money, and those things cost money, and that's why the IRS has these deductions, but there is some definite deductions and credits for having children getting married. The other thing, if you have the option of buying your house versus renting, that is a great way to save some tax dollars. So you get to write off the mortgage interest, which in a lot of cases is most of your monthly payments. You get to write off the real estate taxes every single year. You get to write off mortgage points and other fees that would come up on the purchase statements that you get. And then in a lot of cases, if you run a business, if you have to change your house for medical purposes, you can write those things off. So there's great advantages to owning your own home. It gets you quite a bit of deductions. When you look at the Schedule A, you can see there's the mortgage interest right on the on that form, the taxes for the real estate taxes, and then in some cases you can do some improvements with medical deductions. Now the charitable donations, I really wanted to focus on a few things, and hopefully you can work with me and imagine this in your head a little bit. So if you are a married person and you would like to give a charitable donation to an Arizona public school, this can be an elementary through high school, there is a special Arizona credit where you get dollar for dollar credits back on your return. So let's take a normal average income type of family that's in the 15% federal tax rate and does pay Arizona taxes. So let's say that they give $400 to an Arizona public school. Let's say they give it to their kids' soccer team that they play at on the high school. So they fund their son's soccer team, their equipment, their jerseys, those sorts of things. They give the school $400. They give that donation on December 30th. They do it online with a credit card, and they don't have to. First of all, they don't have to pay that off till January. So you're already you're submitting the charge but not paying it till later. Then when they come to taxes, they put the charitable donation down, and then they also put the Arizona school credit. So they get $400 back on their Arizona taxes. So that's dollar for dollar. So they gave 400, they get 400. Now, in addition to that, they get to have a federal donation, charitable deduction, and that donation will be tax savings to them. So they're basically going to have $60 in tax savings. So we take the $400 times the 15% that we talked about, and they get $60 back on their federal taxes in savings. So if you give 400 to the state of Arizona, your son's soccer high school team, you're going to get $460. So just a little neat little credit that Arizona has available. You basically give the money and you earn it back. Now this can be done for public schools, private schools. There's some working charities and some military credits. There's actually, when you add up everything, you're getting close to 3,000 to 4,000 if you're married and you have enough Arizona taxes to pay. So something definitely to consider, and you can talk to me or another tax professional more about this. The other thing is a lot of you guys are obviously going to school right now. If you're going to school, the government's going to pay for it. Now there's some cases where they don't, where there's exclusions and other things, but if you do not have a scholarship, then you can submit your expenses to the IRS, and they'll give you that those credits back on your taxes. So there's up to $2,500, $2,500 back that you can get from going to school. So if you spend that in school, you got a lot of different things that you can get a big refund for that. So go to school, stay in school, get your degree. You get that for the first 4 years of your education. It's called the American Opportunity Credit. And then if you happen to take out some student loans, you can also write those student loans off on your taxes. So we talked a little bit earlier about the medical. It's important to keep track of that. So let's go back to the example. If you're elderly and you are married, but you don't own or you own your house, but you paid it off, so you don't have any mortgage interest. So you might not itemize your deductions for federal, but let's say that you have $10,000 of medical expenses, and you can write all those off. So you take your medical expenses and some other charities that you have, and you end up itemizing your deductions for state of Arizona, and you write off all your state of Arizona taxes, and you don't pay anything to them. So it's always important to just keep track of your medical to maximize your deductions. Some things to consider when you are planning your taxes. That I have on the slide first, that when you have your babies, you get a divorce, or you get married. I know this seems a little trivial, but for example, if you get married on December 30th, you get to claim married filing jointly, or you get to claim married filing separate. And you cannot claim single because you are now married. So the date is December 31st. So if you have a baby on December 31st, you get a claim of a baby. Um, if you move into getting a divorce on December 31st, you are now single. So you have to either do the single or head of household. Typically, for most clients, married filing jointly is the best way to file. So if you are looking to get married, try to push it to the end of the year. It's better for taxes, you'll get more savings, etc. If you are looking to have children, if you don't want to raise them for the whole year, but you want to get the full advantage of the tax credits, you can have babies at the end of the year and you get the whole $1,000 child tax credit. You get the exemption that they have. So it's a win for those people. So think about those things. IRA distributions and withdrawals. We'll move on to that. If you are under 59 and you withdraw from your IRA, there's an automatic federal penalty of 10%. So you pull $10,000 out of your IRA, that's $1,000 penalty. There are exclusions for that. Medical's one, disability, sometimes purchasing a home. Now it's still going to count as income, but you can get out of the penalties, which is nice. So if you change jobs, don't let that 401k or that IRA sit there. You need to do something with it. You need to convert it. You need to move it over, etc. Now, IRA distributions. So I have clients come to me all the time saying, I need to take money out of my IRA so I can buy a truck, I can buy a boat. That's fine. Use your money, but there's a way to plan this to make this work for the benefit of you. For example, if you are an elderly person and you have Social Security income and you have about $10,000 a year from your retirement distributions, with that situation, you are not looking at any taxes. Now, if you bump up your retirement distributions to 40,000, let's say you want 30,000 for that boat, now you are looking at some brand new tax increases from Social Security income and the 30,000 you pull from your IRA, etc. So what you could do is say, hey, let's get at the end of the year, let's pull 15,000 out in December, then let's pull 15,000 out in January. Then we'll go buy the boat in January. I'll get 15,000 in the first year, 15,000 in the second year, and I can potentially not pay taxes. So this is just a great planning tool to use. I do have times where people do not do these things and then they get hit with a big increase in taxes where they don't plan this out. If you own a small business, another tax planning tool is to get all your books ready as of November 30th, see where you're at for the year, and then when you get in December, if you got a big net profit, you can go and buy some assets. That's why I wrote here when to buy a truck. This is something that can be used you can use it as a great advantage. For example, if you are a machinery company and you need to haul freight and you need to have a few trucks that do that, and you're a small business, let's say you have 100,000 as a net income. If you go buy a truck, let's say it's 25,000, use it exclusively for business, you could potentially write off that whole 25,000 in that month, where in a lot of cases, and in some cases, you only write off about a fifth of that truck. So it's a great tool to get you expensing that full 25,000, rather than in that situation it would have been 5,000. Another tax planning tool, if you have a lot of stock losses, you can look at selling some stock that might have some gains, but then using those losses from prior years to offset those gains. I have a variety of clients that they lost big in the stock market a few years ago. They're still recouping. The rule with most normal stock purchases and sales is you can take $3,000 of losses per year, and that $3,000 or whatever losses you've accumulated keeps carrying forward forever until you die. So if you have some big losses and then you want to sell some stock, get some money out of your investments, and they come out as gains, well, it's going to offset all those losses, and then you basically have zero taxes. I tell a lot of clients who have a lot of capital sales and capital accounts and interest and dividends to do it this way. That way they can avoid the income taxes. So another planning strategy, if you have any wealthy grandpas, there's a gift tax exclusion amount of 13,000. Actually, it's been updated to 14,000 for the future, and it keeps bumping up a little bit every single year. What this is your wealthy grandpa or your wealthy son or your wealthy uncle can give you $14,000 per year, and it is not recorded anywhere. It is a tax-free event, meaning your wealthy grandpa doesn't claim it and you don't claim the income. So if you got any wealthy grandpas, go hit them up before the end of the year. I know a lot of young adults, they have the help of their parents while they're going to school. They'll help them either pay for some college, pay for a down payment on a house, etc. And this is actually person to person. So if you have your mom and dad who are wealthy and you are a young married person, you can have your dad give you 14,000, your mom give you 14,000, your dad give your wife 14,000, and your mom give your wife 14,000. So there is some really neat ways to play this trick. Now, if you ever go over these amounts, it's you just have to look at filing a gift tax return, and that can happen with the help of a tax professional. Some of the common mistakes people make when tax planning, the biggest thing is the retirement distributions. If they pull their money out or they let it sit after they change jobs, then all of a sudden they have to pay taxes on it. I have a lot of cases where people get in credit card debt and they think, hey, I'll just pay all this credit card debt off, and then it will go away, and that's definitely a nice peace of mind. But is it worth it to pay the amount of taxes you're going to have to pay? It's kind of a trade-off. Sometimes you just need to talk to a tax accountant and figure out what's the best route. Another mistake I see with a lot of people is they just over withhold. People will have 5 children and they'll claim 2 on their federal W-4. And that's something that you just have to play year to year. When you get married sometime or you get divorced sometime, you have kids, they grow older, they go out of the house. You got to make sure you keep that withholding correct. So, for example, I have a friend that just had twins at the end of the year. So he went from having 2 kids to 4 kids, and he just got married the year before that. So he went from being single 2 years ago to being married with 4 kids in 2 years. So it changes rapidly. You just got to keep those forms up to date and make sure that you're ready to go on those. When you're looking for a tax professional, there's ways to look at it. There's a few different credentials that are out there. CPAs seem to be the most widely known. It stands for Certified Public Accountant. We have to go through just about a master's degree. We have to keep our education up. We have to get a full week per year of just classes and learning about tax topics and accounting practices and ethics courses, just to make sure that we're on the right page. We have to file with the state. They have a board selection committee to make sure that everybody's in good standing. So it's not easy to get to the CPA credential. Plus, you have to take a pretty rigorous exam. So you're looking at basically a master's degree, a really tough exam, continuing education. You have to work under a CPA for a year to get all those requirements. The EA is an enrolled agent. That is a IRS designation. They have to also pass an exam and they have to keep up with their education, but there's no degree or college requirement for that. So many people can just go to high school and get their enrolled agent's license. It's in a lot of cases, the test is mostly geared towards individuals. They can also represent before the IRS. Now, don't get me wrong, they are definitely keeping up with their licenses and professional, but the CPA credential is just a little bit higher than that. And then there's everyone else. Now, you can decide, hey, I want to be a tax preparer, and you go and you file some paperwork with the IRS. You get a number called a PTIN. It's kind of like a social security number for the preparers, and you can start filing taxes. Now, the IRS is trying to make this a little bit more distinguished, but there are a lot of people who file and prepare taxes who are not CPAs. They're not enrolled agents. They are just there, and they don't have any prior commitments. So when you're looking for a tax professional, you can search out if the CPA is in good standing. You can find out if they have a CPA license, enrolled agent license. Hopefully they got at least a certificate on the wall when you're in their office. If you're not going to their office, then hopefully you can look that up online. The other thing you can do is there's a lot of tax professionals all over the place. You can go to an H&R Block or Liberty Tax, Jackson Hewitt. You can go to a variety of places in car title loans. Now, I'm not saying that those places won't help you file your taxes and they won't do the basic things, but they will miss out on deductions in some cases. The other thing I find is when I have some clients that go to an H&R Block is they base their fees sometimes just on forms, and they don't discount, they don't have a lot of leeway. So for example, if a client has 2 or 3 interest statements and 3 or 4 stocks they sold, they could come out of an H&R Block and pay $500. Whereas if I do their taxes, I can help them out, do it in 45 minutes, and we'll sit together, look for deductions, and I'm not gonna charge you a full $500. So it's something to just watch out for. There's a reason why these places are out there. There's a reason why I do what I do. You just got to find the right fit. When you're going to a tax professional, and if it's your first time, just make sure to bring your prior year returns. Make sure you have the birthdays and socials of everybody, all the updated information, like if you can get the email and the phone numbers and the addresses. And then bring all your current year materials. For most people, it's W-2s and 1099s. Just bring everything that says 2013 that you get in the mail. And then when people come to me, I look for what I call a summary of expenses. Meaning, if they're going to go through the expenses, like if they go through medical or they go through their mortgage interest or their taxes, they need to just bring a summary, not bring what I call the shoe boxes. Meaning they get an old shoe box They get all their medical receipts from their prescriptions and their doctors and their drugs and their chiropractors, and they just throw it in a shoebox and expect the accountant to add it up. Now, I don't mind adding it up, but I'm going to charge you quite a bit per hour to get out a calculator. So you're welcome to do that, but most accountants do not enjoy that kind of work. They don't want to see your receipts. They're not there to try to unfold the thing that's been underneath the car seat for a couple weeks. They're just looking for the totals. They want to put them on the form. They want to help you out, look for the deductions, but get them right. This basically concludes everything that I had for planning and working on your taxes. I have my contact information. Again, my name is Tyler Hamelwright. I'm a CPA. I'm local to the Valley. I can help out with anybody's case. I've done plenty of individual taxation. I've done business taxation. I do bookkeeping. I do payroll. I can help you with health and life insurance. I can help you if you need a notary. I can help you if you have some investment things that you're looking to do, or get a will or a trust, and just a variety of things to do. So thanks for your time. I appreciate you listening to this, and hopefully it was definitely something that will help you out as you go into the spring and file your taxes, that you'll be able to look for those best deductions. So again, thanks and have a great day.